You think you know what the ultra-wealthy are buying? Think again. While the financial media has you fixated on gold prices and Bitcoin rallies, while every talking head on CNBC dissects the latest stock market moves, the billionaire class has quietly shifted their money into three assets so obscure that most financial advisors have never even heard of them. These aren't get-rich-quick schemes. These are civilization-level hedges, the kind of investments you make when you believe the entire system is about to crack. And the accumulation happening right now, in 2025, is unlike anything we've seen before. This is the story the mainstream financial press refuses to tell you. This is about what happens when the people who built empires start preparing for those empires to crumble. This is about farmland, water rights, and disaster insurance transformed into the most strategic assets of the 21st century. And by the time you finish reading this, you'll understand exactly why the smartest money on the planet is moving in a direction that nobody's talking about. Let me take you inside the mind of a billionaire who sees what's coming. The farmland empire you never knew existed. Everyone knows Bill Gates as the Microsoft guy, the tech visionary, the philanthropist trying to solve global health crises. But what most people don't know is that Bill Gates has become the single largest private farmland owner in the entire United States. Not a farming company, not an agricultural conglomerate. One man, through his investment firm Cascade Investment, now controls approximately 275,000 acres of American farmland. To put that number in perspective, imagine a piece of land larger than the entire city of Los Angeles. Picture an area roughly the size of Hong Kong. That's how much farmland Bill Gates owns. And he's been accumulating it systematically, quietly, methodically since 2013. But here's where it gets interesting. Gates isn't just buying random plots of land scattered across the country. He's targeting very specific farmland in very specific regions with very specific characteristics. And when you map out exactly what he's buying, a pattern emerges that reveals something profound about what the ultra-wealthy know about the next 2 decades that the rest of us don't. Gates's largest single-state holding sits in Louisiana, where he owns nearly 70,000 acres concentrated in the Mississippi River Delta. Why Louisiana? Because that land possesses 3 characteristics that make it irreplaceable in a world heading toward climate chaos and food scarcity. First, the soil quality is extraordinary. The Mississippi Delta contains some of the richest topsoil in North America, deposited over thousands of years by river flooding. This isn't something you can engineer or recreate. This is geological wealth that took millennia to form. Second, water access is unlimited. The land sits directly on massive aquifers and has direct access to river water systems. When droughts devastate farmland across the country, this land will have guaranteed irrigation. Third, the growing season is exceptionally long. Some of this Louisiana farmland can produce 2 full crop cycles per year, doubling its productive capacity compared to northern states. Gates isn't buying this land to grow corn in 2025. He's buying the capacity to control food production when climate change reduces farmland everywhere else. The second largest concentration of Gates-owned farmland sits in Arkansas, where he controls nearly 48,000 acres of rice and soybean country with direct access to the Arkansas River. This is the largest rice-growing region in North America. Rice is one of the most water-intensive crops you can grow, and Gates bought land in the exact region where water supply is guaranteed for decades to come. Coincidence? Absolutely not. Move to Nebraska, and you'll find Gates has strategically acquired farmland positioned directly above the Ogallala Aquifer, the largest underground water reserve in North America. This aquifer supplies water to 8 states, but it's being depleted rapidly in most regions as farmers pump water faster than rainfall can replenish it. But Gates didn't buy land in the depleted zones. He bought land in the specific areas where the aquifer runs deepest and where natural recharge rates remain highest. He secured guaranteed irrigation for the next century. In Washington state, Gates owns nearly 17,000 acres, most of it concentrated in the Columbia River Basin. Perfect climate for wheat, potatoes, and fruit production. Unlimited water from the Columbia River system. And critically, the infrastructure already exists to ship crops to Asian markets through West Coast ports. This isn't just about feeding America. This is about controlling export capacity to the world's most populous continent. Down in Florida, Gates holds nearly 15,000 acres dedicated to citrus, vegetables, and cattle. Year-round growing season, aquifer access, and proximity to major population centers on the East Coast. Every single purchase follows the same strategic template. Superior soil quality that cannot be replicated. Guaranteed long-term water access from rivers or deep aquifers. Climate conditions that support multiple growing seasons or premium crops. And Gates isn't slowing down. In June of 2025, his investment company dropped $131 million on another 8,000 acres in Benton County, Washington. That works out to $16,000 per acre. For context, average farmland in America sells for $3,000 to $4,000 per acre. Gates paid 4 times the national average. Why? Because the land he purchased sits in the Horse Heaven Hills region with pivot irrigation systems already installed, direct aquifer access, perfect climate conditions, and most critically, both mineral rights and water rights included in the purchase. That last detail is everything. Because while most people think farmland is valuable for the crops it produces, billionaires know the real value lies in something even more fundamental. Water rights. The most valuable asset class you've never heard of. Let me explain something that most people, even most investors, fundamentally misunderstand about water. In the Western United States, water rights exist separately from land ownership. You can own 1,000 acres of beautiful land and have absolutely no legal right to use the water underneath it or flowing through it. Water rights in most Western states operate under a system called prior appropriation, which essentially means first in time, first in right. Whoever claimed the water rights first, usually ranchers and farmers back in the 1800s, holds senior rights. And in times of scarcity, senior rights holders get their full water allocation first. Junior rights holders get whatever remains, which during droughts is often nothing at all. Now here's where this becomes extraordinarily valuable. Water rights can be bought, sold, and transferred completely separately from the land itself. If you own senior water rights in a region where water is becoming scarce, you're sitting on one of the most valuable assets in the world. Because every city needs water, every developer needs water, every farmer needs water. And when supply becomes limited, whoever controls the rights controls the price. Billionaires figured this out decades ago, and they've been quietly accumulating water rights ever since, while everyone else chased tech stocks and cryptocurrency. The most famous example of water rights wealth creation is T. Boone Pickens, the Texas oil billionaire. In the 1990s, Pickens started buying land in the Texas Panhandle, but he wasn't buying it for the land. He was buying it for the water underneath. The land sat above the Ogallala Aquifer, and Pickens systematically assembled water rights to extract 65 billion gallons per year. That's enough water to supply a city of 1 million people. In 2011, Pickens sold just a portion of those water rights to 11 Texas cities for $103 million. Not the land, not the actual water, just the legal right to pump water. That works out to $1.58 per 1,000 gallons. Compare that to what cities typically pay for water from traditional sources, which is pennies per 1,000 gallons. Pickens made a 10 times return by simply controlling access. And he still owns the majority of his water rights, which are currently valued at over $500 million. But Pickens isn't an isolated case. There's now an entire industry of Wall Street firms systematically buying water rights across the American West. Water Asset Management, a New York-based investment firm, has been acquiring farmland in Colorado specifically for the water rights attached to it. They've purchased over 2,500 acres of farmland along the Colorado River. The land itself might be worth $50 million, but the senior water rights attached to that land are valued at over $300 million. The firm's president stated explicitly in a 2022 interview that their entire strategy centers on profiting from water scarcity. They buy land with senior water rights, implement more efficient farming practices that reduce water usage, and then sell the excess water rights to cities and developers desperate for supply. It's water arbitrage, and it's completely legal. In California, the Resnick family has taken this playbook to an entirely different level. Stuart and Linda Resnick own the Wonderful Company, which produces pistachios, pomegranate juice, and mandarins. You've bought their products. But that's not where their billions come from. Their fortune is built on water. Starting in the 1990s, the Resnicks began buying farmland throughout California's Central Valley. Tens of thousands of acres came with water rights. But they didn't stop there. In 1994, California held a series of regulatory meetings about water management. The Resnicks showed up. Most cities weren't paying attention. Those meetings resulted in new regulations that allowed private entities to control water banking. Water banks are state-built facilities that store water during wet years and release it during droughts. They were constructed with taxpayer money, but the new regulations allowed private companies to control who receives the stored water and at what price. The Resnicks acquired control of the Kern Water Bank, the largest water storage facility in California, with a capacity of 1.5 million acre-feet. That translates to roughly 500 billion gallons. During droughts, which have become frequent in California, the Resnicks sell water from the bank to other farmers and cities at massive markups. They've made billions not by producing anything, but by controlling access to water stored in public infrastructure. And they're far from the only players in this game. In 2021, the Church of Jesus Christ of Latter-day Saints bought 20 to 2,500 acres of farmland in Washington state for over $200 million. They outbid Bill Gates's investment company in the auction. Why would a religious organization spend $200 million on farmland in eastern Washington? Water rights. That land comes with senior water rights on the Columbia River system, guaranteeing water access essentially forever. The Mormon Church now ranks among the largest agricultural landowners in the western United States, not primarily for crop production, but for water access. The aggressive pursuit of water rights continues to intensify. In 2021, a Wall Street-backed company called Crown Columbia Water Resources filed an application with Washington state to acquire private water rights throughout the Columbia River watershed. Their business plan was to buy water rights from farmers, bank them with the state, and then lease or sell that water to cities and developers. It would have represented the largest private water rights acquisition in American history. After significant public backlash, the application was suspended. But the company didn't disappear. They're still operating, still buying water rights quietly through smaller transactions that don't require state approval. The message is unmistakable. Water rights in the American West are being systematically consolidated into the hands of billionaires and investment firms who understand that water scarcity is not a possibility, but a guarantee. Climate change is reducing snowpack in the Rocky Mountains. Colorado river flow has dropped 20% over the past century. The Ogallala aquifer is being pumped faster than natural processes can recharge it. Every scientific projection shows Western water supply decreasing, while demand from growing populations continues increasing. Whoever controls water rights in 2030 will be wealthier than whoever owns oil in 2030. Because you can live without oil, you cannot live without water. The obscure financial instrument, paying 17% returns. Now let me introduce you to the third asset. Billionaires are accumulating at record rates in 2025. This one is so obscure that most people have never heard of it. Most financial advisors couldn't explain it if you asked. But the ultra-wealthy have been pouring money into this asset class because it offers something almost impossible to find in traditional markets: high returns that are completely uncorrelated with economic cycles. They're called catastrophe bonds, or cat bonds for short, and they might be the most fascinating financial instrument you've never heard of. Here's how catastrophe bonds work. An insurance company covers properties in Florida against hurricane damage. If a major hurricane hits, the insurance company could face billions in claims, potentially more than they can handle. Traditionally, they would buy reinsurance, essentially paying another company to take on some of the risk. But reinsurance is expensive and has limited capacity, so instead, they issue a catastrophe bond. The insurance company creates a special purpose vehicle, essentially a shell company, which issues bonds to investors. Let's say $500 million worth. Investors buy these bonds, and that $500 million sits in a collateral account invested in safe treasury bonds. The insurance company pays the investors a premium, typically 5 to 10% above treasury rates. So, if treasury bonds yield 4%, cat bonds might pay 9 to 14% annual returns. If no hurricane hits Florida that year, investors get their principal back plus the premium. Nice return, relatively low risk. But if a hurricane does hit Florida and causes more than a specified amount of damage, let's say $10 billion in insured losses, the cat bond triggers. That $500 million in the collateral account gets transferred to the insurance company to pay claims. Investors lose their entire principal. The bond defaults. That's the risk. You might think this sounds insane. Who would invest in bonds that could be completely wiped out by a single hurricane? The answer is billionaires, pension funds, hedge funds, and sovereign wealth funds, because the returns are extraordinary. And critically, the risk is uncorrelated with everything else in the financial system. Let me show you the numbers that make this compelling. In 2024, the average return on catastrophe bonds was 17.4%. Not a typo. 17.4%. Compare that to the S&P 500, which returned about 7% in 2024. Compare it to investment-grade corporate bonds, which returned maybe 5%. Catastrophe bonds nearly tripled the return of stocks and more than tripled the return of traditional bonds. The previous year, 2023, cat bonds returned 19.8%, again crushing every traditional asset class. And here's the truly remarkable part. During the market meltdown of early 2025, when Trump's tariff policies caused the S&P 500 to drop 15%, catastrophe bonds went up 1%. While stocks crashed, while real estate values fell, while even gold briefly dropped, cat bonds held steady and continued paying high yields. Why? Because tariffs don't cause hurricanes. Trade wars don't trigger earthquakes. Stock market crashes don't create floods. Catastrophe bonds are completely uncorrelated with economic cycles. They're tied to physical events, natural disasters that happen regardless of what the economy is doing. This is what billionaires understand that retail investors miss. True diversification isn't owning stocks and bonds. Those are both correlated with the economy. When the economy crashes, both typically go down together, as we saw in 2022 when a traditional 60-40 portfolio got destroyed. True diversification means owning assets whose performance is independent of economic cycles. And catastrophe bonds represent the purest expression of that principle. The cat bond market has grown explosively. As of November 2025, the total outstanding cat bond market exceeds $50 billion. That's up from $33 billion in 2020, representing a 50% increase in just 5 years. And issuance is accelerating. In the 12 months from August 2024 to July 2025, insurers issued $23 billion in new catastrophe bonds. That's the highest issuance year in the entire history of this market. Why the explosion in growth? 3 primary reasons. First, climate change is demonstrably increasing both the frequency and severity of natural disasters. Insurers are facing more claims than ever before. Traditional reinsurance capacity cannot handle the volume, so they're turning to capital markets instead. Second, insurance premiums are rising across the board. When premiums increase, cat bond coupons increase proportionally. Higher yields attract more investors seeking returns. Third, institutional investors have realized that catastrophe bonds provide genuine portfolio diversification that traditional assets cannot offer. So, who's buying these bonds? Dedicated insurance-linked securities funds like Fermat Capital Management, Plenum Investments, and Stone Ridge Asset Management. These are specialized hedge funds focused exclusively on cat bonds, managing billions in assets. Major pension funds, including the California Public Employees Retirement System, one of the largest pension funds in the world, allocate to catastrophe bonds. Canadian pension funds, European pension funds, and Middle Eastern sovereign wealth funds have all entered this space. Multi-strategy hedge funds that normally invest in stocks and bonds are now allocating 5 to 10% of their assets to cat bonds, specifically for diversification purposes. Even major asset managers like PIMCO, Amundi, and BlackRock now offer cat bond exposure to their clients. Even reinsurance companies themselves invest in cat bonds issued by other companies. Swiss Re, Munich Re, and other major reinsurers both issue catastrophe bonds and purchase other companies' cat bonds. It's a massive, sophisticated market that most retail investors remain completely unaware of. And the returns remain compelling. Over the period from 1997 to 2025, catastrophe bonds have generated yields that exceed their expected losses by an average of 4 percentage points per year. That means the average cat bond pays you 4% more than what's actually justified by the statistical risk of catastrophe. Why does this excess return persist? Because investors demand a premium for taking on unfamiliar risk, and because the market remains relatively inefficient compared to traditional bond markets. Sophisticated investors who can accurately model catastrophe risk can identify mispriced bonds and earn substantial excess returns. Let me give you a concrete example of how this works. In 2011, a catastrophe bond called Mariah Re was issued by American Family Mutual Insurance Company. The bond covered severe thunderstorms and tornadoes across the United States. The bond paid investors 6.25% per year for taking on the risk. The trigger was simple. If industry losses from tornadoes exceeded $825 million in a single year, the bond would trigger and investors would lose their $100 million in principal. Investors analyzed historical data. Tornado losses had exceeded $825 million only once every 10 to 15 years historically, so they were being paid 6.25% annually to take on a risk that might materialize once a decade. The odds seemed favorable. Except 2011 turned out to be the deadliest tornado season in United States history. Over 983 tornadoes touched down. Total damages reached $21 billion. Industry losses hit $954 million, exceeding the trigger. The bond activated. Investors lost the entire $100 million. That's the risk with catastrophe bonds. But here's the crucial part. Even accounting for that total loss, investors who held a diversified portfolio of catastrophe bonds over the 2010 to 2020 period still earned an average return of 11% per year, because most bonds didn't trigger. The few catastrophic losses were more than offset by the high yields earned on the majority of bonds that paid out normally. It's a pure probability game. If you hold a diversified portfolio of cat bonds, you will occasionally lose money when disasters trigger specific bonds. But over time, the high yields more than compensate for those periodic losses. And critically, the returns remain uncorrelated with stocks, bonds, and real estate. That's why pension funds and billionaires keep pouring money into this space. But something especially notable is happening in 2025 that represents a structural shift in this market. Historically, approximately 75% of catastrophe bonds covered hurricane risk in the United States, primarily Florida, Texas, and the Gulf Coast. But in 2025, issuance is diversifying dramatically. We're now seeing catastrophe bonds covering earthquake risk in Japan and California, wildfire risk in California and Australia, flood risk across Europe, and even mortality risk from potential pandemics. The types of issuers are also expanding. It used to be almost entirely reinsurance companies issuing cat bonds. Now primary insurance companies are issuing directly. In 2025, 58% of catastrophe bonds were issued by primary insurers, up from 48% just 2 years ago. This means companies like Allstate, State Farm, and Farmers Insurance are bypassing traditional reinsurance entirely and going straight to capital markets to transfer risk. The risk, of course, is that Tucker gets hurt or significantly underperforms, and the Dodgers are stuck paying premium money for diminished production. But that's a risk with literally any contract, and the shorter-term nature of this deal actually mitigates that risk compared to a 10-year. Why does this structural change matter? Because it means catastrophe bonds are becoming mainstream infrastructure for the entire insurance industry. They're no longer a niche product. They're critical to how the whole system functions, and that makes them significantly less risky for investors. The market is deeper, more liquid, and more diversified than ever before, which is precisely when sophisticated money floods in before the opportunity compresses. The catastrophe bond market in 2025 is where the mortgage-backed securities market was in 2000. Early stage, specialized, offering high returns, not yet understood by mainstream investors, but growing rapidly and about to become a core asset class. Billionaires are positioning themselves now before retail investors figure it out and before yields compress from increased demand. The pattern behind the accumulation. So let me connect these three assets for you: farmland with water access, water rights themselves, and catastrophe bonds. What's the common thread? Why are these three specific assets attracting billionaire capital right now? They all share four critical characteristics. They are scarce, essential, inflation-proof, and disaster-resistant. Consider scarcity first. You cannot create more farmland with premium soil and guaranteed water access. That land was formed by geological processes over thousands of years. There are only so many acres positioned above deep aquifers or alongside major river systems. You cannot create more water rights. They were allocated in the 1800s under prior appropriation laws that remain in effect today. The number of senior water rights is fixed forever. You cannot manufacture more disasters or alter fundamental catastrophe risk. These risks are determined by geography, geology, and climate, factors completely outside human control. Now consider how essential these assets are. Food, water, and disaster insurance represent non-negotiable human needs. When the economy is booming, people might buy luxury goods, travel internationally, invest in speculative assets. But when times get hard, food and water become the only things that matter. And when disasters strike, insurance becomes the difference between survival and bankruptcy. These three assets fulfill fundamental human needs that persist regardless of economic conditions. They are also profoundly inflation-proof. When currencies devalue, farmland prices rise because food prices rise proportionally. As money loses purchasing power, the real assets that produce food maintain their value. Water rights become more valuable as scarcity increases and more money chases limited supply. Catastrophe bonds pay floating rates that adjust with inflation, so yields automatically rise when inflation accelerates. All three assets maintain real value regardless of currency debasement or monetary policy decisions. But the most important characteristic is disaster resistance. Farmland survives economic crashes. It survived the Great Depression. It survived the 2008 financial crisis. It will survive the next crisis because land continues producing food regardless of what's happening on Wall Street. Water rights survive everything. In fact, disasters often make them more valuable as supply tightens and desperation increases. Catastrophe bonds are literally designed to survive disasters. They pay high yields precisely because they're engineered to be uncorrelated with market crashes. When stocks collapse, when bonds default, when currencies fail, these three assets continue producing value. Billionaires aren't accumulating these assets expecting 5% annual returns. They're accumulating them as wealth preservation vehicles for the next 50 years. They're positioning for a world where currencies become unstable, food becomes scarce, water becomes expensive, and traditional financial assets become dangerously volatile. These aren't speculative get-rich-quick investments. These are civilization-level hedges against systemic failure. How ordinary investors can gain exposure. So the obvious question becomes, how can you gain exposure to these assets without being a billionaire? You obviously can't buy 69,000 acres in Louisiana. You can't outbid Bill Gates for Washington farmland. You probably can't negotiate with Texas ranchers for Ogallala aquifer water rights. And you certainly can't write a $10 million check to invest in a catastrophe bond fund. But you can gain exposure. Let me show you the accessible entry points. For farmland, the easiest access point is farmland REITs, real estate investment trusts that own farmland and distribute rental income as dividends. Farmland Partners trades under ticker symbol FPI and owns 177,000 acres across 300 farms. It pays quarterly dividends, and you can buy shares for about $11 as of November 2025. Gladstone Land Corporation, ticker symbol LAND, owns 168 farms totaling 112,000 acres, focused on fresh produce and high-value crops. It pays monthly dividends and trades around $15 per share. These aren't perfect substitutes for owning farmland directly. You don't receive the same tax benefits as direct ownership. You don't control water rights. But you do gain exposure to farmland values and agricultural income, and you can enter with $1,000 instead of $1 million. Another option is fractional farmland investing through platforms like AcreTrader and Farm Together. These platforms pool investor capital to purchase individual farms. You can invest $15,000 to $50,000 in a specific farm and own a fractional share. You receive a proportional share of crop revenues. Some platforms even allow you to see exactly which farm you partially own, making it much closer to direct ownership than a REIT, while still remaining accessible. Water rights exposure is more challenging because there's no public market for water rights themselves. They trade privately between sophisticated parties. But there are indirect exposure methods. Water utilities like American Water Works, ticker symbol AWK, own water rights and infrastructure across multiple states. When water becomes scarce, utilities that control rights and distribution infrastructure benefit substantially. Water infrastructure companies like Xylem, ticker symbol XYL, manufacture pumps, filtration systems, and water management technology. As water scarcity intensifies, demand for their products increases proportionally. Water-focused ETFs provide diversified exposure. The Invesco Water Resources ETF, ticker symbol PHO, holds a basket of companies involved in water infrastructure, utilities, and technology. While this isn't direct water rights ownership, it's tied to the same fundamental trend of increasing water scarcity and rising water values. None of these vehicles perfectly replicate owning senior water rights on the Colorado River, but they provide exposure to water scarcity value creation without requiring you to navigate complex legal negotiations for private water rights purchases. For catastrophe bonds, there are now mutual funds and ETFs providing retail access to this formerly institutional-only asset class. Stone Ridge High Yield Reinsurance Risk Premium Fund, ticker symbol SHRIX, invests in cat bonds and other insurance-linked securities with a minimum investment of $1,000 on some platforms. Pioneer Cat Bond Fund, ticker symbol CBYX, is another mutual fund focused specifically on catastrophe bonds. These funds provide exposure to the same asset class that pension funds and hedge funds access, but packaged in a mutual fund structure with daily liquidity. The downside is fees. These funds typically charge 1 to 2% annually in management fees, which reduces your net returns. But you're receiving professional risk management and diversification across dozens of catastrophe bonds that individual investors could never access directly. There's also the Swiss ReCat Bond Index, which several ETFs track, providing broad exposure to the entire catastrophe bond market. Returns won't match the highest performing individual bonds, but you receive market average returns with significantly lower risk through diversification. The signal you cannot ignore. Now let me be extremely clear about what this information represents and what it doesn't. This is not financial advice. I'm not instructing you to buy these specific assets. I'm showing you what billionaires are systematically accumulating and explaining why they're doing it. Whether you choose to follow that lead is your decision based on your personal risk tolerance, investment timeframe, and financial situation. But you need to understand what's happening at the structural level. The ultra-wealthy are moving capital out of traditional financial assets and into real, scarce, essential resources. They're not doing this because they expect 20% returns next year. They're doing it because they believe the financial system in its current structure is fundamentally unsustainable. And when it eventually breaks, the things that will matter are food production capacity, water access rights, and disaster risk transfer mechanisms, not stock certificates, not bond contracts, not even cash itself, the assets that produce food, the rights that control water, the instruments that transfer catastrophe risk away from your balance sheet. Those are the assets that preserve wealth across regime changes, currency failures, and system collapses. And the ultra-wealthy are accumulating them now, in 2025, before the majority of people realize what's coming. Bill Gates didn't accidentally become the largest private farmland owner in America. He executed a systematic strategy over 12 years, quietly acquiring the most productive, water-rich farmland in the country while everyone else chased tech stocks. T. Boone Pickens didn't stumble into owning water rights worth $500 million. He bought them decades ago when nobody else understood their value, recognizing that water scarcity was inevitable and whoever controlled the rights would control the price. Pension funds didn't suddenly allocate billions to catastrophe bonds because they were bored or following a trend. They did it because their sophisticated risk models demonstrated that traditional 60-40 portfolio diversification completely failed in 2022. and they desperately needed genuinely uncorrelated assets to protect retirement savings. The pattern is visible if you know where to look. The trend is undeniable once you see it. The only question is whether you recognize it in time to position yourself accordingly. These aren't the only assets billionaires are accumulating. There are others. Rare earth elements essential for technology manufacturing. Nuclear energy infrastructure as the world transitions away from fossil fuels. Agricultural technology companies that will feed a growing population with less available farmland. Strategic commodities that become critical during supply chain disruptions. But farmland with guaranteed water access, water rights themselves, and catastrophe bonds are three assets currently in peak accumulation phase that remain accessible to people who aren't billionaires. The window exists right now to gain exposure before these asset classes become prohibitively expensive or completely institutional. If you take nothing else from this deep dive, take this fundamental insight. When you see billionaires systematically accumulating boring assets that seem completely irrelevant to current market conditions, pay very close attention. They're not buying for today's market. They're buying for the day when everything else fails. And on that day, the person who controls food production, water access, and risk transfer will be far wealthier than the person who owns stock certificates and bond contracts denominated in a currency that no longer functions properly. That's not pessimism or doom-mongering. That's pattern recognition based on historical precedent. Every reserve currency in history has eventually failed. Every empire eventually crumbles. Every financial system eventually gets replaced. And every single time that transition happens, the wealthy who saw it coming and moved their capital into real assets years before the crisis survived and thrived. Those who waited until the crisis was obvious lost everything. This is that moment. The accumulation is happening right now. The pattern is clear. Whether you act on that information is entirely your choice. Your next move. So what do you do with this information? That depends entirely on your situation, your resources, and your conviction level. But here are the key takeaways you need to understand. First, traditional diversification is not sufficient protection anymore. Owning stocks and bonds used to provide adequate diversification because they sometimes moved in opposite directions. But in the modern financial system, with coordinated central bank policy worldwide, stocks and bonds increasingly move together. When the system faces stress, both decline simultaneously. Real diversification now requires assets that are completely uncorrelated with financial markets. Assets tied to physical realities rather than financial abstractions. Second, the assets that will preserve wealth through the next crisis are not the assets that generate the highest returns during the current expansion. Gold performed terribly from 2011 to 2019, while stocks soared. But when crisis hit in 2020, gold proved its value as a wealth preservation tool. The same principle applies to farmland, water rights, and catastrophe bonds. These assets won't make you rich quickly during boom times, but they'll preserve your wealth when everything else collapses. Third, positioning early means accepting lower immediate returns in exchange for protection against tail risks. Farmland rates might yield 4% annually, while tech stocks promise 15%. But when tech stocks drop 40% in a crash, farmland maintains its value. The lower return is actually insurance premium disguised as opportunity cost. Fourth, you don't need billions to benefit from this strategy. Even allocating 5 to 10% of your portfolio to these alternative assets provides meaningful diversification benefits. You're not trying to replicate Bill Gates's farmland empire. You're trying to add genuinely uncorrelated assets that will perform differently than your stocks and bonds when crisis arrives. And finally, the time to position is always before the crisis becomes obvious to everyone. By the time farmland values double and water rights make headline news, the opportunity has already passed. The billionaires accumulated when nobody was paying attention. That's why they're billionaires. The question is whether you're positioned before or after the crowd realizes what's happening. The ultra-wealthy aren't smarter than you. They don't have secret information. They simply have longer time horizons and better risk management. They think in decades rather than quarters. They focus on wealth preservation rather than wealth creation. And they understand that boring, essential, scarce assets always win over the long term because those assets fulfill fundamental human needs that never go away: food, water, and disaster protection. 3 things humans have needed since civilization began. 3 things humans will still need when the current financial system is a historical footnote. And 3 asset classes that billionaires are accumulating right now while everyone else chases the next hot stock or cryptocurrency. The choice is yours. You can chase the assets that already ran up. You can follow the financial media's recommendations about what's hot right now. You can keep doing what you've always done and hope the system doesn't break. Or you can look at what the smartest money on the planet is actually doing with their capital and ask yourself why they're moving in a completely different direction than they're telling everyone else to move. The billionaires buying farmland aren't talking about it on CNBC. The investment firms accumulating water rights aren't advertising their strategy. The institutions pouring money into catastrophe bonds aren't encouraging retail investors to follow them. They're doing it quietly, systematically, and relentlessly because they see something most people don't. They see a system approaching its breaking point. They see currencies that will eventually fail. They see food systems that will face massive disruption. They see water becoming the most contested resource on the planet. And they see traditional financial assets becoming increasingly disconnected from real economic value. So they're buying the real things: the farmland that grows food, the rights that control water, the instruments that transfer catastrophe risk, the boring, essential, scarce assets that preserve wealth when everything else fails. That's the story financial media won't tell you. That's what billionaires are really buying while they tell you to buy index funds. That's the pattern that's visible if you know where to look. Now you know. What you do with that knowledge is up to you. But remember this: the biggest fortunes aren't made by following the crowd. They're made by seeing what's coming before anyone else does and positioning accordingly. The billionaires are already positioned. The only question is whether you'll join them before it's too late. If this deep dive into what billionaires are really buying opened your eyes to a completely different investment reality, do me a favor. Hit that like button. Drop a comment below telling me which of these 3 assets surprised you most. And subscribe to this channel because this is the kind of information the mainstream financial media will never share with you. This is about seeing the game the ultra-wealthy are actually playing while they distract everyone else with the game they pretend to play. Don't be the person who realizes what happened 5 years too late. Be the person who saw it coming and positioned accordingly. Thanks for reading, and I'll see you in the next one where we go even deeper.
Hey everyone, I'm working to hit 1,000 subscribers and I need your help to get there. If you enjoy this content, please hit that subscribe button right now.